All right, let's get into it. Today we're taking a close look at the latest numbers from GKE Corporation, and honestly, they're a bit of a puzzle. You see, the company is bringing in more money than before, but their actual profits have taken a serious nosedive. So we're going to unpack exactly why that's happening and what it all means if you're an investor.
Yeah, it's the kind of question that makes you double-check the numbers, right? How on earth does a company's sales go up while their profits go down? Well, that's the big mystery we're solving today by looking at GKE's results.
Okay, so first, let's look at the good news. The company's total sales, what we call revenue, actually grew by a pretty solid 5.3%. That brings them up to 66.5 million Singapore dollars for the first half of their fiscal year. More cash coming in the door. So far, so good. But, and this is a big but, here's the twist. The money that's left over for shareholders, the net profit, it didn't just take a little dip. It absolutely plummeted by a staggering 57.5%, all the way down to just $1.9 million. So where did all that cash go? Let's dig in.
Before we get into the weeds, you might be asking, who is GKE anyway? Well, they're a big Singapore-based company, and their main game is warehousing and logistics. So think giant storage spaces, managing complicated supply chains, that kind of thing. But they also make strategic investments in other areas. And believe me, that's going to be really important in just a minute.
So how do we explain this massive drop in profit? It really comes down to something we call a profit squeeze. Let's unpack the numbers and see exactly where that pressure is coming from. Now, to get what's happening, we need to quickly talk about something called gross profit margin. Don't worry, it's not as complicated as it sounds. Just think of it like this. If you sell a t-shirt for $10 and it costs you $7 to make, your gross profit is $3. That means your margin is 30%. It's a super important number that tells you how profitable a company's core business really is. And this right here, this chart shows GK's problem perfectly. Just last year, for every single dollar in sales, they kept almost 31 cents as gross profit. Pretty good. But this year, that number has dropped to less than 27 cents. Now, that might not sound like a huge difference, but when you're talking about millions of dollars in revenue, those few cents add up to a massive hit to the bottom line. So where's the pain coming from? Well, what's really fascinating is that they're two big traditional businesses. The ones that are usually the most profitable both took a serious hit. Revenue from warehousing and logistics was down almost 12%, and their infrastructural materials business down by a whopping 43%. That is a major blow. So what happened? Well, the company lays out a few clear reasons. For one, they're spending a bunch of money on startup costs for a brand new venture in Dubai. At the same time, they're renovating a key warehouse in Singapore, so that's temporarily reducing their capacity. And get this, their materials business in China was literally rained out by unusually heavy weather. And finally, and this is key, they've jumped into a new business that just happens to have lower profit margins. But hold on. Remember, their total revenue actually went up. How is that possible? Well, it's because while their old businesses were struggling, a brand new engine of growth was just firing up. Just look at this breakdown of where their money is coming from now. You see that big new piece of the pie labeled retail and distribution? That's already bringing in almost $15 million in sales. It's become their second biggest business segment almost overnight. And what's crazy is just how new this is. This business, which sells mobile phones and accessories, literally didn't even exist a year ago. It's a textbook diversification move. They're trying to protect themselves from the ups and downs of their industrial businesses. But as we've already seen, this new high-volume business comes with lower margins, and that is a direct cause of that profit squeeze we talked about. Now, this move into retail isn't just some random thing they're trying. No, it's part of a much bigger, much bolder strategy. You could say GKE is making three huge bets on its own future. First, they're doubling down at home, securing their key Singapore property for another 20 years. Second, they're looking to spin off their China business into a separate company, hoping that'll unlock more value for investors. And third, the biggest bet of them all. They're pouring an estimated $120 million into a massive expansion into Dubai. These are not small, timid moves. This is a company going all in. And the company is being totally upfront about this. Their own CEO, Mr. Neo Chao Hui, said it plain and simple. They knew their profits were going to be lower for a while because they are in the middle of these huge expansion plans. So to them, this isn't a surprise. It's all part of the strategy. So you're an investor. You're looking at all this. What do you make of it? Well, it's a classic story, really. It's a company that is choosing to sacrifice some profit today in the hope of getting much, much bigger rewards down the road. It's the ultimate short-term pain for long-term gain playbook. Let's just break it down really simply. On one hand, you've got the short-term problems, what we can call headwinds. Squeezed margins, big spending on expansion, and those temporary disruptions. But on the other hand, you have some potentially massive long-term wins, or catalysts. That brand new, fast-growing retail business, a huge international expansion, and the chance to unlock a ton of value from their China assets.
So, what's the bottom line here? GKE is a company in the middle of a massive change. Management is very clearly choosing to focus on long-term growth instead of short-term profits. The biggest risk here? Execution. Can they actually pull off all these ambitious plans? But if they do, the opportunity for growth is absolutely huge.
And that really brings us back to the most important question for anyone looking at GKE right now. The company is making a very clear, very calculated trade. They are spending today's profits to build a bigger, hopefully more profitable company for tomorrow. So the only question that really matters is this: will their big bets actually pay off?